Let's talk earnings and favorite pastimes.
So let me just say, earnings
stupidity
by
of Wall Street. That's 2.5x.
Because their compensation goes up.
Wall Street's wrong again.
We're at the Stansberry conference this week, and we've had a lot of really good conversations. As always, I've got Professor Joel Litman, Chief Investment Officer of Altimetry, here with us. And we actually have Austin Root, the head of Stansberry Asset Management, $1.2 billion in AUM now at this point.
That's right. Yep.
With us too.
Yeah.
And so, I mean, Austin, it feels like at this conference, everybody has to have a take on whether or not we're in a boom market for AI or we're about to have a bust for AI because the bubble is in. And we thought you had actually an interesting take in terms of where you think the market is now. You want to give everybody some context?
Great. Well, listen, great, long-time listener, first-time caller, guys. So
love it.
Great to have you
really,
on.
yeah, no, great talking with you both. And we were trading thoughts before this. So I guess we're a little bit in between there, where we do see the productivity gains in the economy generated by AI. And we do believe those are real and will manifest themselves in continued growth in the economy, and then also in corporate earnings, and then also in stocks. So by and large, we're of the belief that markets power higher from here, not without hiccups. But then the piece that I think makes us a little bit in between is that as asset prices are so high right now, we think it's more important than ever, and it's always important, but more important than ever, that individual investors be mindful of limiting their downside. Mm-hmm. The drawdowns in portfolios can be so taxing for folks, not just emotionally limiting.
In your presentation, you talked about the Buffett's 2 rules of investing, right?
That's right.
Yeah.
That's right.
Yeah, that was good.
It was, rule number 1 is don't lose money, and rule number 2, never forget rule number 1.
I mean, I think to your point, right, when you think about if we're in a bull market still, right, we always talk about the idea of the 1990s, right? And from 94 to 2000, it was a phenomenal bull market, but there were 10 times that you had 10+% pullbacks.
That's right.
And if you had a portfolio that was, so volatile that you squeezed yourself out of it, you were at loss. So what do you think is the right way if you have that kind of outlook to position a portfolio? Yeah,
so for us, the traditional thing is to talk about being diversified, and that is important. You want to diversify your asset, your portfolio over multiple bets, but not to get too wonky. But you guys do a lot of accounting, uniform accounting, a lot of wonky stuff. So we're in good company. That only gets rid of the unsystematic risk of a portfolio.
Mm-hmm. Yes.
The other piece you can reduce by lowering the correlation of the assets. So you lower your correlation of your overall portfolio by owning assets that are less correlated to one another. Mm-hmm. So that's what we're looking to do. We want to own world-class businesses, those enduring franchises that we think will be bigger, more profitable businesses a decade from now than they are today. Yep. So that's the core of our portfolio. But around the perimeter, we're trying to add assets that have a lower correlation to the overall market.
What do you think are the kind of assets that you're thinking of that have that lack of correlation? I think you mentioned the idea of producing assets is one thing. Is there anything else that you think of as a way to find those non-correlated assets or uncorrelated? Yeah,
I'll give you a couple examples. One basket that we like to look at is merger arbitrage investments. So when a company announces that it's going to acquire a public company for cash, sometimes for stock, but a simple explanation is for cash. The example I like to give is when IBM said they're going to buy Red Hat software for $190.
Yes.
The stock didn't go right to $190. It sat at $165 because there's risk of that deal happening. There's time value of money.
Right.
The key to that, though, is while there is risk in that deal, it's idiosyncratic risk. Yep. It's whether the deal gets financing, whether it has shareholder approval, whether it has...
very company specific.
That's right.
You're not worried about the market or what happens or
exactly.
a new tariff or something like that.
Exactly, Joe.
Yeah.
So there will be many days where the market goes down and the spread on this merger arb doesn't do anything at all. Because the risk or the prospects of that deal happening has not changed at all.
Yeah.
So that's a type of something that we like. I'll give you another one that we really like. Financial exchange businesses.
Mm-hmm. Yes.
Oddly enough, when the world gets scary, and if you see a big drop in the market, what happens to volumes that are traded over these financial exchanges? They go up.
Yeah.
So it's actually a business that benefits.
It's a natural
volatility.
hedge.
It's a nice hedge in the market.
Yeah.
Well, I mean, it has been wild. I was looking recently, and the fact that Interactive Brokers is a $120 billion market cap business now is wild.
Fantastic business.
But right to your point, because what they've done, right, is they've basically said, hey, how do we add international trading, we add prediction markets, and we add all these other basically growth factors that have nothing to do with what you think the economic cycle is. It's about where you think things are going from volumes, and it makes all the difference in the world.
I think that's right. I think that Tom Petterfy's greatest value add, as CEO and founder of Interactive Brokers, was basically saying, okay, I want to be the Costco of the brokerage world, where we can provide a better value, a better service at lower prices.
But get volume for doing it.
But then make it up on volume.
Yes, right.
Exactly.
Yeah.
Hey, but you know what? When basically the marginal cost for you is basically nothing, you can do that.
Right.
So which is impressive for him.
That's right.
So you're in the asset management business, right? Obviously, and Sam, in terms of what you do, when you think of what are things that you think other asset managers or just asset management industry in general, what do you think that the industry gets right, and what do you think that the industry gets wrong that you think that you guys do that's special?
You've been managing money a long time, right?
Yeah,
exactly.
That's right.
You were a Tiger Cub, right, on a Julian Robertson. We're talking 20-something years ago, right? You were Stevie Cohen,
right?
At one point.
Yep.
So what's different now?
Yeah, so it's a great question. Those are both great questions. I think in those environments, I was working for institutional investors. And so when you think about the context of Stansberry Asset Management, or SAM as we like to call ourselves, we're largely focused on individual investors and family and investing family capital. But we're bringing those institutional grade strategies and lessons learned and best practices to this asset management. But I'll tell you what we do. It's a little bit of a back to the future thing in that so much of the investment world has bifurcated. So you have investment management on this side. So think about the T. Rowe Prices of the world that are creating the investment strategies, but don't really have any relationship to the end client that's actually utilizing those strategies. And then you have a lot of wealth managers that build the relationships. They help with financial plans and very mission critical things, but they utilize the T. Rowe Price strategies. And so they don't actually have any input on how the capital is managed.
Right.
But that's what you're paying for them for. What a novel concept to bring these things back together.
That's wealth manager ideas, but with also the money manager.
That's right. So Sam, we have experts on both of those in-house. So my team is on the investment management side. And then when I started and we joined 4.5 years ago, we brought a world-class team of wealth managers, so certified financial planners. So when you're a client of Sam, you can reach out to me, but you also have a dedicated wealth manager to help you through a lot of the important things that are, frankly, on a given year basis, more important than the stocks that you own is how you're allocated, thinking about how it's from a tax perspective or how it's positioned, even talking about things like insurance and other things.
Because you're not running one big $1.2 billion fund.
Correct.
You're running 10 strategies.
That's right.
And you're fitting those strategies across the 1.2 billion. I mean, it accumulates to 1.2, but it's different strategies for each family, for each individual.
That's exactly right. So they have a separately managed account that we manage on their behalf that could be a tailored mix of our strategies that could be wholly independent to them and wholly unique to them based on their goals. So our strategies, we believe that every investor has 3 goals. Get rich, stay rich, generate sturdy current income. Some mix of those. But they also have some mix of investment time horizon, risk tolerance, et cetera. So there's a mix of those things that are going to be best for them.
Well, that's wildly different than from just running institutional money back in the day, right?
That's
back
right.
in New York 20 years ago.
When I had a hedge fund, we had one commingled vehicle, and this was, do you like vanilla? Because that's what we got.
Yeah, exactly. That's all we do. There's no chocolate here. I mean, Joel, it's not dissimilar for what we talk about for timetable investor, right?
Yes.
Yeah, exactly. And right, for context, right, for what we think about and what we, for all of our Altimetry subscribers, we always teach that exact same point that you're saying, right? The idea that, hey, what matters first and foremost is actually not what stocks you own. It's making sure based on where you are, not in terms of how old you are, but where you are in terms of your needs in your life.
Yes.
How much should you have in stocks? How much should you have in bonds? How much should you have in cash? Or, the assets that are like those things.
Yes.
Right, which really sounds like, what you're kind of waking up and saying, hey, we have to think about that first for people first.
Each client.
Because if we don't do that right for any individual client, and all of them are different, right, nothing else actually matters.
That's 100% right. So owning the right investments is mission critical, but having the right allocation of those investments is every bit as important.
Yes.
Austin, so, being in the wealth management and the asset management industry, there's, what is your favorite part about the job?
Yeah, I still am innately curious about businesses, how they work.
The stock picking side.
The stock picking side, yeah. I think that this is an inherently fascinating time to be an investor.
Yeah.
And so I still think that my favorite thing is identifying businesses that we want to own, and then ideally owning them for the long term. We have a bias, much like Buffett, that the ideal holding period is forever.
Yeah.
So long as we still believe in the investment story.
Yes.
Now, we will sell for risk management purposes. We'll sell if the story changes, or we'll sell if we find a higher and better use for that capital.
Yeah.
But finding those higher and better uses is the part that really gets me excited.
What kind of turnover do you have from a stock picking standpoint?
Yeah, and
for that part of your investment.
It depends on the strategy. So we have our SAM Forever strategy, where we try to hold businesses essentially forever. Obviously, low turnover in that.
Yeah.
We have another strategy called Tactical Select, where we are, by the nature of it, we're trying to be very tactical in that business. So we believe that investing is seasonal. You don't have to own every asset all the time.
Yeah.
And so in something like that, we will have more turnover on an annual basis.
And now the most important question, do you ever use Altimetry research for
We do, absolutely. We are big believers in the work you're doing for uniform accounting. We are big believers in free cash flow. And so that's as at the end of the day, how much cash are you generating over a long period of time? There can be flows in and out of that based on a big investment in either your balance sheet or whatnot. But by and large, what you guys are looking at is what we're looking at. Generate cash and keep doing it and do more of it, and we want to own your stock.
Very good. What we're doing. It's just, I assume we're saving you time. I'm sure you could do the adjustments we talk about, but do you have the time to do the adjustments for everything you're doing? I think that's probably where because you're using a lot of market-wise tools, right?
That's right.
Whatever, the best of whatever brings to bear.
I think that one great tool, one great asset that we provide for our clients is, they're learning. They oftentimes will stay subscribers, almost always stay as subscribers and keep learning. But we have a whole team that can utilize and optimize the research that's being done across market-wise.
All the research, yeah. Really good.
Yeah.
No. And I think we alluded to this earlier. Your what's best? What's about your day? What's the worst thing about your day?
I would say, because I love the investment stories, and I need to stay on top of that. The worst part is I'm not really taking a vacation when the market hours are when the market's open. So I am not looking forward.
That's your career. That's the career you chose.
Yeah. But I enjoy it. Right. What I would say is, I am not looking forward to the prospect of 24/7 trading. I'll tell you that.
It's funny. Right, you were on Wall Street. You were on the buy side for a while in terms of, right, as you said, at a Tiger Cub, at SAC, and I think of some of them who are trading in Japan and everything else. And I'm like, oh, I'm so sorry that you have to wake up in the middle of the world. Yeah. So in the middle of the night. So as the last question that I think we'll leave you with here is now is. And for us to leave the viewers with is, you talked about, whether or not we're in a mania, whether or not we're in a good market, a bad market, an up market, a down market. If you think of the one thing that actually keeps you up at night right now from an investing perspective, so people can know what they should be thinking about, what would you say is the one thing?
Yeah, it's a great question. I think that there's a lot of those one things here at the conference. People worried about the dollar losing its reserve currency status, or AI displacing too many jobs and actually being negative for the economy. I'm not concerned about those things. We watch them, and I do think that the dollar is challenged. that AI will displace some jobs, but I believe that the productivity gains will be good and the economy will grow. The thing that I guess I worry about the most is just the geopolitical smoke that we have out there, right? And particularly China. I just think that there's enough issues there that we just want to be hyper careful of what's going on in China.
Yeah.
I don't know that there's anything necessarily that we can point to.
Do you have a lot of international exposure though?
Yeah, I think that we mix it. We care very deeply about the accounting and rule of law. So a lot of our international exposure is on U.S. listed stocks.
Yes,
but not wholly.
But you tilt that. You lean that way.
That's probably right. Yeah, but an example would be the Mercado Libre, U.S. listed, but that's a Latin American company, and it's a big. We're a big believer, a long-term holder in that. It's had some hiccups recently, but big believer in the long-term opportunity there.
No, it makes sense. I mean, right, China, obviously a thing that we talk about all the time in terms of the risk there. So that makes sense.
I mean, I'm deeply worried about China in a number of different ways. It is definitely a melting ice cube in terms of an economy. The question is, at some point, does it drop as opposed to just slowly,
Right, or do they do something rash because of that melting ice cube nature?
That becomes a big problem.
Yeah.
Well, congrats on your business. I mean, 1.2 billion. Whenever you cross $1 billion, that's a big deal. So
we're plugging away.
Fantastic, man.
On behalf of our clients.
And Austin, really quickly, if anybody wants to learn more about the business.
Yeah, I thank you. I think stansberryam.com. That's stansberryam.com.
Awesome.
Very good.
Awesome.
All right.
Thank you, man.
Thanks so much, man.
Great seeing
Absolutely.
you guys. Thanks a lot.
Thanks.
Yeah.
Thank you so much, everybody.